How are you all? And this is our Saturday normal 3:30, and we share our knowledge right here with you. So what we want to do today is to focus on some tax bill saving opportunities, still not yet late, and you can still do. And before we go on with that, we'd like to introduce our firm to you by showing you our website. This is our website, communitycpa.com. You can come over here to click on the appointment. Then you will see all of the partners that at the firm who chair certain line of business. So you can click any one of us, make appointment, see our availability. So this is what we offer to you online. So we do have a lot of remote clients who are never really in our physical location, but they utilize us on the website and clicking on the appointment, so we see them in Zoom. Then of course, everything we talk about today or yesterday and the knowledge we have is all shared right here at youtube.com. And if you come to YouTube, you just type in Community CPA, you'll find us, you'll find our channel, and you can subscribe to our channel. The benefit of subscribing to our channel is that you will get notification from us when we have topics come up for the upcoming webinar. And some of the topics are maybe you don't have time and you're not yet making that a priority, then you know that, oh yeah, that topic was at one time aired, so you can come over here to find it. Or if it is interest to you while you are driving right now, you can just listen to us. So what we're trying to do is just to make it easy for you. We know entrepreneurs are busy people. I know you don't have time to sit in the classroom learning things, and you don't even have time to call your parent to say hi. So I know that. And so for that reason, all of our webinars is also in the listening quality, which I mean is you don't have to watch us. You can just put it on the run and then listen to it. So today is the same thing, and we will be having you seeing what we prepared and listening to what we prepared for you. So the topic of today is optimizing your small business 2023 tax bill. So obviously the year is almost over. You had a great year. You are looking at paying bills. What bill? Tax bill. Yes, income tax bill. So our job here is to give you our last minute recommendations. Of course, if you go to our YouTube channel, you type into tax planning 2023, you will pull up all the tax planning topics we talked about in the past. That's a really good way to catch everything, including this one. So this one, we just want you to know that what you can do before the end of December. Prior to talking about, sharing about the knowledge, we always give you a quick run of who we are. My name is Ingersoll. I am the managing partner for Community CPA. Community CPA is not a young firm. We are at least young adults, 25 years in the making. We have over 10,000 clients, 3 physical locations with professional staff in the location. We actually have California location where we don't have professional staff, it's a remote office. And you can also check into our credentials, knowing that I have served on National Taxpayer Advocacy Panel. This is the Federal Advisory Committee for 3 years. And I have also written 2 books so far, An Appointment with Ying at 8 a.m., then Appointment with Ying at 10 a.m. The 2 books is just outlines how you start a business and how you grow business. And we are, we are now into the 2 p.m. book, which is called Appointment with Ying at 2 p.m., where we talk about merger, acquisition, and organic growth of your firm. It's expansion talk, not just growing. Then of course our number 4 books that we have in the plan is 6 p.m. where that is to retire or repurpose of your life after making the business going. So fun, right? So the books are such a good way to elaborate a normal business process. You start, you grow, you expand, then you retire, right? And it's such a negative word to say retire. I would just say repurpose, right? All right. So, of course, everything we share here is a free knowledge. So you know that you take responsibility and don't just blindly trust information you got from, on the internet. But we do have a lot of people coming to our firm because of the information we posted on the internet. But it is not because they only see us, then they come to us. It's because they have seen so many. They decided that Community CPA is more reliable, reputable, and we know what we're talking about. Our webinar also are very down to earth. We don't do crazy amount of buffaloing and it's just not coming to the point. We actually do give you that knowledge. All right. So is there still a time to do tax planning, to save tax liability, to pay less tax bills? The answer is yes, but the time is running short, right? And a lot of those tax strategies, and you really need to implement that before December 31st. We're already on the 2nd of December. Yeah, not a lot of time. I will tell you that the busiest time in the year for someone like me is actually not the time that we're filing taxes. It's actually the time we're planning the taxes. So I probably have 9, actually up to 9. I couldn't handle more than 9 a day appointments. So, those appointments are, just things that we need to do. We need to clean up. We need to create so that way our tax liability can be manageable. So yes, there's still time, but not very long. So if you happen to feel the crunch of the time, not sure what to do, contact our office. And in this December month, it's just everybody's busy months because there's holiday, there's family gatherings, there's travels. Pandemic is over, people are more elaborated or more free at going around. So there's just less of a time. But as a business owner, you are just like me and you are responsible for what you're doing. So you want to consider your finance before you really just enjoy the holiday, forgot about your tax liability is at the door and you need to take care of them, right? There are strategic steps can still be taken to cut tax liabilities for your business. All right, let's dive into those. Time deductions and income. So this actually is being very popular, right? You know 1 or 2 of these points because when you are realizing that, I made a lot of money this year, I want to pay less taxes, what do you immediately thinking? You're thinking of spending. You're thinking of, let's buy a truck. Oh yes, let's spend money now so that we don't pay taxes. So this is what we call the timing the deductions, right? So this is the deduction and you want to do. But when you do these deduction timing and you want to know your accounting method. So I have 2 slides related to that, kind of dealt with accounting method. Accounting method means that whether you are cash accounting or accrual accounting. So the bottom line is, if you are cash accounting, you're like, you have to make sure the money went out of your bank account already before you can count that as your expense. And if it is accrual accounting, maybe you paid some expenses, but it didn't really come out of your bank account. But because you are accrual, so you can deduct. But out of cash accounting or accrual accounting, the real important thing is that the thing you are deducting, it is already in service. For example, if you are selling Christmas trees, so you bought the trees already, but your bill is not due until sometimes in February next year. But you're already selling the trees, right? So that product you bought is already in service. That's why if you are on accrual accounting, you can deduct those tree expenses. But if you are on cash, ladies and gentlemen, and you cannot, because if you are on cash accounting, you haven't really paid the bill yet, and how are you going to deduct, right? So you're timing your deduction. So maybe you are saying that, wow, Ying, and I am on cash, but this is really the money I need to pay, but I just don't really trust my contractor. I just want to give 1 or 2 days to see how things are doing, and I pay them on January the 1st, but the work is done already. But if you say that I'm a cash accounting, I cannot pay these people, then that means I'm going to make so much money because the expense is going to go to next year. So in this case, what I recommend you to do is to actually get a money order from the bank and already pay out to the contractor, and you just wait until you check on their work before you give that money order to them. But as long as this money order is already come out of your bank account, right? So that's how you work with the cash method accounting. And you see how when we timing the deduction, so important is that you know what accounting method you're using. So this is about timing deduction. What about income? Whether you are cash accounting or accrual, and the income must be something you earned. What if you are actually have a subscription service for your clients? For example, you are a training company and you train your clients, but you collect the fee in December for the next whole year. And are you going to include all this income you received in December into your tax return? You haven't even earned it yet. That is not even your income. Am I right? It is actually your liability. It is no different from you, borrowing money from the bank and saying that, I got an income. No, you didn't. That is your liability. So if you did not earn it, ladies and gentlemen, you need to know it is so clear to yourself. So that deposit in your bank account, even if you're on cash method, should not be counted as income. You hear me, right? All right. Then what about I am accrual? I am accrual, and I charge that ahead of time, and then I am sure I'm going to get that, I'm going to perform that service. So again, if you haven't really earned it, it doesn't matter your cash method or accrual method, you really do not make it. And for accrual method, yes, you should accrue the income that is reasonably certain that will happen in the next month to 3 months. So you say that, well, I'm on accrual, but I'm not sure. Sometimes the people don't join my training session. I return the training fees just because they don't join. Then in that case, maybe you, and you also refund them the money, then you should not count as income, right? But what if you have a policy saying that if you don't cancel it within 30 days, whatever you paid me, it is assumed it's already earned. So depends on your policy, ladies and gentlemen. So I want you to hear me really clearly. So if you earned it, you should report that as income. But if you did not earn it, you should not report that as income. For a cash method and accrual method, the difference is even if these accrual method and need to be reasonably sure, or you have a policy in place that you won't let them income going back to the client again. For example, if you got this training education going on, client has to cancel 3 months ahead of time. So by December, your January, February, March income should already be secured because they did not cancel. You should accrue that into your income because that is your accounting method. And that accounting method also allow you to accrue expenses. It's a fair game, right? So you cannot be like, oh yeah, I am accrual on expenses, but I am cash on income. Well, not a fair game. And so with this, I think you kind of got the sense of timing for deduction and the income, and you know what to look for, right? Here on our slides, we said that cash basis business can impact taxable income by accelerating deduction into 2023 and the deferred income into 2024. So don't deposit that payment check you got from client and in December and deposit them in January so you can defer, you can push out that income, right? Example would be you could put reoccurring expenses normally paid early in the year on your credit card before January the 1st, so you can write that off, right? You can claim the deduction for 2023 even though you don't pay the credit card until 2024. So this is more like, you know, the cashier's check is working the same way, and in certain circumstances you can prepay some expenses such as rent, insurance, claim them in 2023. All right, and then of course for accrual accounting, as for deferring income, wait until the close to the year end to send out invoice to customer with reliable payment histories, right? You know your client is reliable, then don't send them the invoice, don't create receivables, right? Accrual basis business can delay the delivery of goods service until next year. So you can also push your service to next year, saying that, well, you know, it's holiday season, everybody is busy, my staff is taking a break, and I don't have, we're gonna do it next year in January. So defer that. With that said, that concludes one sector of the conversation today, that is timing your deduction and income. Regular stuff, nothing earth-shattering, but it is something I want you to gain realization and understand as a business owner what you should be looking at. Buy asset is the second topic we have here. Consider purchasing new and used equipment, machinery, and office equipment. Place asset in service by December 31st for a 80% bonus depreciation in 2023. It was 100% in 2022, but this year dropped to 80%, and the next year, 2024, 60%. So you may say that, what does that mean? What does that mean? So let's say you bought a computer equipment for $5,000 and you want to place them in service, means that it's already in your office, you're already using it by December 31st, then 80%, that 5,000, 4,000 can be deducted out of your income. Only the other 1,000 is left behind for normal depreciation. So in 2022, the 5,000 can be deducted all at once, but not 2023. It's only 80%. One thing about bonus depreciation, I want you to remember, bonus depreciation can create loss. What I mean by that is, let's say you did not make any income in 2023, but you bought a $10,000 equipment and it's in service. You just haven't really got lucky enough that to make any sales. So you produce dumplings, but nobody buying it yet, and you bought the machine for $10,000. And this $10,000, we can use bonus depreciation, so $8,000 will be deducted. So you got no income, $8,000 equipment cost, so you have a loss of $8,000. Am I right? And bonus depreciation allow you to have a loss. So you can create company loss, business loss by using bonus depreciation. Why do I say that? Because there is another depreciation, and it's called Section 179. That has an income limitation. If you don't have an income, you cannot use 179. You cannot use that depreciation method to create a loss. So let's continue to talk what other point I have on buying asset. So bonus depreciation is available for certain building improvement, like leasehold improvement. If you happen to start a new business in 2023, and you did a renovation on your retail space, and made a sign and things like that, those are building improvements, and you actually can use bonus depreciation, which means that 80% of your spending can be deducted. Section 179 can do a full write-off of 2023 asset. See, Section 179, well, the bonus depreciation is only 80% right now, but 179 can do 100%. So let's just understand about this 100%. The equipment must be, for Section 179, these are conditions. The equipment must be purchased and used before December 31st, 2023, okay? So it is important it is in service. This is just like earlier we're talking about, what kind of expense you can deduct. It's very key. The thing is in place for you to use. And both new and old equipment, and as long as used for more than 50% for business purpose, qualifies, okay? And in 2023, the maximum deduction total is 1.1 million, 1.160 million deduction. So, up to 2.8 million addition. So, which means that if you bought a $2.8 million equipment, and then you actually can deduct 1.1. So that's a 179 limitation. And 179 limitation, which I didn't write it here, I want you to know, it is that it doesn't create a loss. This is to assume that you actually have profit for 1.1 million, so you can wipe out the profit, pay no taxes, okay? These are items you can utilize 179. So, you may say that, okay, I understand. So what are the things I can, write it off based on Section 179? Equipment and machinery, business vehicles, computers, off-the-shelf computer software, which means that it's not, it's something like QuickBook, something you buy it off the shelf. Office furniture, equipment, cost of certain improvements to business buildings, see right there, and a certain agriculture storage structures. Okay, so these are 179 applicable. And now I know that you saw this one item called the business vehicle, so I want to elaborate this a little bit more. Purchase a heavy vehicle. So what is heavy vehicle? Heavy vehicles is the vehicle has the overall weight of 6,000 pounds. So where are you going to find this information? It's actually, when you buy the vehicle, if you open the driver's side of the door, it's actually listed there. It has a labeling tell you what is the pounds for the car, like the weight. If it is over 6,000 pounds, even though it is a SUV or Ford 150, those kind of truck, and they are considered heavy vehicle. So when you buy a heavy vehicle, and you can deduct it, and based on this bonus depreciation and 179, so I had an example here for you. The example we have here is Lisa purchased her new pickup and put it in use in 2023. Okay, so she bought Ford 150 and she's driving it in 2023 and 100% for business. And she put it in use right away. As soon as she bought it, she paid $55,000 total. So that weight on the car door is GVWR. Don't ask me what that stands for. It just gives you that number, right? So it is a Ford 150. We knew for sure that is a heavy vehicle. So now this car can do bonus depreciation or Section 179, right? So if Lisa made money in that year, Lisa can go for $179 because it's 100% deductible. But if Lisa didn't make enough money and cannot be 100% deducted, then Lisa will go for bonus depreciation. So here, she could take full Section 179, deduct the whole vehicle. Okay? He can also elect to take 80% of bonus depreciation, which is $44K. Additionally, and she will also deduct the regular first year depreciation, which is $12,200. If I add these two up, it is actually over the total vehicle price, right? So then, as a result, it is $55,000 all deductible. Then you will say, Ying, you know what you're saying is the same. I can do bonus depreciation or 179. It's the same. It's the same result. You show that it is not, because if your business did not make $55,000 profit, your 179 not gonna work. So only bonus depreciation can create $55,000 loss for you. Okay, just keep that in mind. Obviously, you don't have to keep anything in mind. I just want you to hear us, and if you need us, come over to Community CPA and we take care of you. Okay, and then this is more like on the deduction side. On the equipment side, we're talking about, right? We're talking about buying vehicles, and we talk about, how that would qualify 179 or bonus depreciation or your leasehold improvement, all of these things that you're doing. So what if you say, well, Ying, why do you just talk about heavy vehicle? What about the lightweight vehicle? What about my, I am a nurse, I'm a traveling nurse, I just have a little Toyota driving around, so what kind of deduction I have? Then you actually just gonna go for the first year deduction, the $12,200, and then another 4 years depreciation. And if you are having a business and with, with this traveling nurse kind of activity, then that's 100% business use vehicle, then you can do bonus depreciation, right? So there's ways to take care of you. So don't ever think that, this has to be a truck, a van, and a thing's big. And if you are in that business and that particular car is your business asset. So with that said, let's look at what other things we have at this last minute. Ying, don't tell me I have to go to dealership to go get a car. Come on, I don't want a car. I already bought 3 of them. I had a client every year when he got the tax refund, he'll buy a truck. So literally, by the time he of course had already retired for quite some years. But by the time we finished, he retired, he had 15 trucks in his farm. So that's what happened with people, and you don't need 15 trucks. And, this particular client I have really just maybe had a collection of trucks, I would say, just so many trucks, and he uses in the farming. With that said, let's look at what else can we look into at the last minute and also benefit us, right, for the year end. So we need to talk about contribute to the deferred benefit plan. A lot of small business don't have elaborate, defined benefit plan. And what we have and we know it is SEP plan, 401k, and things in that nature. So 401k solo is a big play. And here, if you are the only worker and shareholder or member of your business, and you should look into 401k solo, because you have deferrals right there, right? If you're under 50 this year, you can put away $22,500 without paying income tax. So what I mean by that is, let's say your business gave you a W-2, okay? And your business gave you a W-2 that is paid you $22,500 salary. And you remember the W-2 has the first box That is your gross salary, and then you have an income tax on the side, then your Social Security amount, your Medicare amount, and also Social Security withholding, Medicare withholding amount on the side, right? Those are the famous 6 boxes we see on the W-2. Remember, if I can put $22,500 into 401k solo plan for you, your W-2 first box is 0. You actually didn't have any taxable income, but your business can deduct the $22,500, can deduct Social Security Medicare contribution, and you are an employee of your own business. So furthermore, not only that, I can match 25% of $22,500, which is your gross salary, and deduct that out of your business expense. So if you are the only employee for your business, and 401k is really a very economical way to put in more money and to get more deduction. Of course, if you are not the only employee, you might look into 401k profit sharing plan, and that is a plan that used by many small business. And so you as a business owner will set up the plan for your company and encourage your employee to put in money and getting the retirement saved up. But for you as an owner, you actually can put the maximum out. If you are over 50, you can do $30,000 this year, which means $30,000 of your income do not need to pay income tax. And if you are actually at the higher tax bracket, I am talking about $30,000 saving and going away from regular taxable income to 401k deferral, and that would save you close to $9,000. So it's not a small deal. It's actually pretty efficient for you to save money. Of course, there are businesses, when they grow bigger, they have profit sharing plan. Then they also have cash balance plan. Cash balance plan that can put away another chunk of money from your profit into the cash balance plan for the future retirement of you and your employees. Just a lot of ways to really reduce your tax liability, right? And if you want to know more information about that, contact us, and we actually can guide you through that process, working with your financial planners if you have one, and to build that for you. And we can definitely help you save big dollars at the last minute. But that cash balance plan does take time to set up, so you want to move on faster. Then don't procrastinate, right? Keyman Life Insurance is another one. If you're so important, you're the owner for the company, and you got 10 employees, and everybody is relying on you, the company's surviving on you, and you don't buy a Keyman insurance for yourself, what's going to happen if you die and you're just going to let the 10 people go without a job forever? So that's not a good thought. And what you can do is you can buy a life insurance for yourself, but beneficiary is your company. So even if you die and your people are still going to get paid for a little bit to run down or to transition your business, right? So those are also things you can do, help you to reduce your tax liability, at the same time benefiting your people that who work with you and you have a lot of connection with. I mean, in life, really you only have this small group of people. It's not big. It is not like billions, millions people out there. No, you probably just have about 20 people in your life that you really know them well, they know you well. And our job, as a good, caring person, then we want to make sure that at least these people who know you well as a business owner, and you take care of them as well if you are not in this life anymore. So Keyman Life Insurance is actually very important. I always encourage our business owner to do that, because it is something that could save a lot of drama, and you are gone and the company also have no more income. What do you want people to do? So you want to make sure that if you're gone and there are still stabilities and at least running for 2 more years before they have enough time to think through things and to wind down or wind up, right? Just in case you are a very bad manager, so they will wind up because without you they do better. That's not my point, but this is just one more tax saving suggestion, right? Now, there are on our YouTube channel, we have a lot of webinars we spoke about in the past. There is a concept created by Community CPA. You're not going to find anywhere else, but it's just with Community CPA. And you have this 3-dimensional tax saving strategies we're teaching people of, right? So you can type in that term, then find our videos over there and really learn what we're trying to say to you. And some tactics may impact other aspect of the deduction. So it is not like it's all isolated, right? If you did a bonus depreciation, you can't do Section 179. And if you bought a passenger vehicle, then the treatment is different than the heavy duty vehicle, right? So all of these things, and you want to think of them together. And if you identified some of those unearned revenue, but you didn't know that, so you've been reporting revenue ahead of time or early, or you even reported it wrong. So those are the things you want to think through and understand your path. Or if you just got overwhelmed, then you need to look for professional help, because tax saving strategies, it is not exactly simple. It is something that needs a coordination and understanding, needs someone with macro economic views of how each of your entity going. So imagine if you have 10 different entities, there's a lot of coordinations that we need to do. So consult with us if you want a tailored strategy for your specific situation. And maximizing tax planning opportunity, folks. Do planning. Why do you want to step into your tax years and your tax return without even know where you're going to be? So maximizing your tax planning opportunities right now and do good for yourself, right? And conclusion. We want to conclude our today's webinar. And so just to say that the tax planning is not a cookie cutter. Everybody is different. Every business is different. So make sure that you're optimizing your own tax situation. That requires you to have a careful thought and meticulous planning steps. You can contact Community CPA at 515-288-3188. That is our main number. It rings at all of our locations, and we open on Saturday. Like today, I'm on a webinar, no big deal, because our Saturday office is open, and you can always find us if you are a remote client or you just don't have time to visit us into our location on Zoom. We are zooming in and out every day, all the time. Like, how am I going to do 9 appointments in a day? That is because of the virtual technology allow us to do that. Allow me to be in and out quickly for every of my client. So you got Catherine's email contact is Catherine@communitycpa.com, and our phone number 515-288-3188. And we open Monday to Saturday, 6 days a week from 8:30 to 5:30. If you have never met any other CPA firms open on Saturday for you, you have us. We always are here for you. I'll talk to you again. Hopefully you take home 1 or 2 good points today and practice it and learn it and be a really responsible business owner of your own business. I'll talk to you again. Bye-bye.